Welcome to Real Economy and to London, one of the most important financial centres in the world. In this episode, we'll be focusing on the proposed European Banking Union, considered key in averting any future financial crisis. On the show today, we'll break down what works and what is still a bone of contention with Sharon Bowles. She is the chair of the European Parliament's Economic and Monetary Affairs Committee. We'll also talk about how a banking union impacts not just the banks, but governments and you. Will it change the face and nature of banking? And most importantly, can it avert future crisis? We know through this Eurozone crisis that some banks have been too big for individual countries to effectively regulate and backstop. So, not surprisingly, around 40% of the EU's GDP has been committed to them as aid over the past 5 years, and 13% of that aid has been used. But to have an effective single financial market, removing fragmentation and the possibility of a future crisis, we know we have to fix the bank balance sheets, but we also have to keep an effective eye on their vulnerabilities, fixing the problems before they become too big. Something our very own Gianni Maggi explains the proposed banking union is supposed to try and achieve.
The storm that blew up from the United States with the subprime crisis led to mega bailouts of European banks. At the same time, the sovereign debt crisis triggered, caused in some cases by the financial effort to save the banks. But in other cases, it was the sovereign debt crisis to drag down the stability of the banking system. The contagion of the crisis between banks and states has worked in both directions.
It's essential to break this vicious circle that means a crisis runs up between, on the one side, out-of-control public debt, and on the other side, the balance sheets of banks that are likely to become hedge funds.
The solution is the banking union, but its implementation is still controversial, with a prudent approach by Germany.
When we look at the French system, there are very few banking groups, while in Germany the number of banking groups, all small banks, etc., is extremely important. So when you change rules, the operating mode of the system as a whole will change drastically, and thus modifies the financing of the economy.
I believe that today's controversies between, on the one side, the Commission and French policy, and the other side, Germany, these are positions that will eventually converge. There are two approaches, but the substance of the fundamental objectives of the banking union are quite widely shared.
The European Central Bank is entrusted with the task of supervision, carried out so far by the national central banks. The ECB may conduct stress tests on individual banks, but to complete this work of prevention, there must be a cure, like a single mechanism for crisis resolution. And that's what the European Commission proposed and is now in the hands of member states.
So now we know why we in Europe need it, but what exactly is a banking union supposed to be? Here's our jargon-busting crash course.
In 2008, the financial crisis virus made many banks in Europe sick. Defenceless, without a necessary vaccine, these banks threatened potential contagion across countries since government debt was close to bank debt. A banking union was proposed as treatment and cure. Preventative treatment is now in place with a single rulebook for EU banks and a single supervisory mechanism. The SSM under the European Central Bank will take care of Europe's banks, making sure that potential problems are found before they become too difficult to cure. Agreeing on a cure has been harder. The single resolution mechanism aims to close down troubled banks at minimal cost to the taxpayer. The Common Deposit Guarantee Scheme is intended to protect savers and ensure depositors are treated equally. Both have met with resistance. Clarity in this will decide if Europe has a healthy banking union or one that is susceptible to sickness.
The ECB begins in November a year-long review of 85% of Eurozone banks. They'll be checking their asset quality, doing a risk assessment and then a stress test. But a single resolution authority and a common deposit scheme still are very hotly debated. So I caught up with Sharon Bowles. She's the chair of the European Parliament's Economic and Monetary Affairs Committee, and began by asking her what was so controversial.
if we're going to levy the banks, everybody likes the idea of levying the banks to build up a fund, but then that will take ages. So what happens if in the meantime you need money in the fund and there's not enough there? Where are you going to get it from? And that's the point of contention, that there is not yet a desire in some countries to mutualise legacy debt. And that's where we come back to the can we use the ESM? And the prickliness around, is there enough money in the ESM? Does that mean we then have to be on the hook potentially for more money? And will we actually be mutualising an old legacy debt, or would it only be new debt going forward?
Do you think there's too much emphasis that's being put on the amount of public support that's going to be needed for these banks?
The talk about bailouts and backstops is still too prevalent in the language that is being used. There is also perhaps the tendency in Europe to run to the fund too early.
Yeah.
Instead of, it seems to be a middle stop more than a backstop. If you could draw a line in the sand that, well, that's the legacy, and OK, we're never going to mutualise that legacy, but we jointly share what is going forward. We even seem to be now backing off from that there is reluctance, particularly on the part of Germany that sees itself as the paymaster, to mutualise. In fact, there's been quite a shift in their approach, even during their election period.
What are the compromises that we need, do you think?
The small member states or the poor member states feel that their banks will always be at risk, whereas the rich member states' banks won't be. And that goes against the notion of banking union. You've all to be in the same place. They've all to be equally safe, which means you need a backstop fund. So you come full circle. I think they should bite the bullet, actually, and say same supervisors, the European Central Bank, applying the same set of rules to all Europe's banks, so it's a joint responsibility if it goes wrong.
We'll continue the conversation with Sharon in just a bit, but first take a look at the top 5 banks that have been bailed out during this crisis. They've been from the UK, Ireland, Spain, Germany. In total, 60 European banks have received state aid. Others, not so lucky. Gianni Maggi took a trip back in time to Portugal to see if a banking union could have averted trauma for some.
Between 2008 and 2011, the Portuguese economy experienced dramatic moments. The bonds were priced at too high interest rates, the credit rating downgraded to junk, speculative waves hindered the first attempts at recovery. The state has come to the brink of bankruptcy. In this situation, with a banking system which proved too fragile, many citizens and businesses have seen their savings and investments vanish. Jaime Antunes is the entrepreneur at the head of an association of victims of the bankruptcy of Banco Privado Português, which involved about 5,000 customers' debts of €1 billion.
The bank, to give better returns to clients, invested this money in long-term products, high-yield obligations and long-term options. When the crisis happened from 2008, obviously there was a devaluation of these assets and the bank was unable to meet its liabilities to customers.
After the failure of the bank, dozens of suits were filed in court against the state that seized the assets of the BPP and against the central bank for lack of supervision.
Customers who invested in private equity products or assets with some more risk, in some cases recovered 40%, 50%, and then there is a limited number of individuals that lost their entire capital.
In 2011, Portugal received a €78 billion bailout from the European Union and the International Monetary Fund. The state has set aside €12 billion for the recapitalisation of banks. Just over a half has been used to date. To these are added a further €12 billion for default loan payments and a further $1 billion for the rescue of a single bank. The question now is, could all this have been avoided with a system of guarantees at European level?
A single supervisory mechanism could have had a different concern regarding enhanced macroprudential issues. Perhaps the issue here is more about the level of behavioural supervision rather than prudential supervision. It's much more than a technicality to hold more stress tests, for example, or force banks to a higher level of reporting to supervisors. I think it needs a much more detailed know-how about how banks work.
Continuing our conversation about the banking union is Sharon Bowles. Sharon, thanks very much for sticking around. Do you think if we had a banking union in its current form without any changes, we could have avoided the situation in Portugal, things that happened in Spain?
If you take the situation that everybody within the Eurozone is equally supervised, equally capitalised, you would think that there would be less opportunity for squabbles. And of course, one would have already looked at the systemic risk amongst lots of smaller banks like the Cajas together. So it's not a question that you can ask, because banking union is accompanied by all of the other changes that we have made to make the banking system safer.
Do you think we're going to get a close to the original banking union somewhere in the near future, or a watered-down version somewhere down the line?
Well, I think we're actually going to get a somewhat watered down from the original version, but quite soon, because the deposit guarantees has gone. Maybe the funding arrangements are not going to be as concrete as hoped. We've already got the supervision. I think we will get a single resolution authority, and we will get some kind of levying on the banks. The bit that is the ultimate backstop of, is there access to a substantial pool of money from the ESM? That one, I think we might get a little, but not a lot.
Well, that's a wrap on this episode of Real Economy from London. Join us next time to talk about the regional economics of growth in Europe.